Nike just released their latest quarterly figures after the market closed. At first, the stock was up 4%, and now at the time of making this video, the stock is down 4 to 5% or so because guidance was given during the call. Now, even when guidance was not given, the stock was up, I had some questions because, let's be honest, this was not a good quarter. Okay, this was not a good quarter. For those that thought that this was the quarter where everything changes, sorry to break it to you, was never going to happen. The CEO himself said it 3 months ago. The turnaround story is going to take longer than expected. And if I'm being honest here, there are way better companies to invest in today than Nike. Even in that same industry, for example, one of the big competitors now in the footwear, On Holdings. It's a company that is currently cheaper and growing faster than Nike. Now, I can understand you're buying Nike because one, a defensive play, it's paying a small dividend, and you are betting on the turnaround story. Now, I'm the last person to say that turnaround stories are garbage. I have a couple of turnaround stories myself in the portfolio. But Nike is just, to me, not that exciting of a turnaround story. Could be proven very, very wrong, of course. But at the moment, by the way, if you didn't know, Nike today is much more expensive than Nike 5 years ago, or even Nike 1 year ago, despite the stock being down. Why is that? Because future projections, if you look at forward PE, for example, forward PE for Nike at the moment sits at 41. If we look at trailing 12 months PE, that's set at 22.6. So again, a lesson here to be learned. Just looking at a PE doesn't tell you anything. You have to know what type of business you're buying. And yes, if we're looking at the drawdowns for Nike, we're now down 50% in the last 3 years. Of course, this stock was already down a couple of times, 30, 40% or so. Year on year, stock is down 32%, and year to date, the stock is down 16. Now, after hours, maybe closer to 20% or so. Has a market cap of just under $100 billion. And so let's discuss the most important figures for the quarter and a couple of things that management told us during the earnings call. If you enjoy this type of videos, hit all the buttons. We'd really appreciate that. The Micron earning recap is already live on the channel, so if you want to watch that, that will be in the top right corner. If not, hit the like button, subscribe. Would really appreciate it. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so first up, quick recap for the quarter itself. So I just said, not the greatest quarter, even though we've got here lots of beats. Small misses here, well, smallish misses. We've got a miss for revenue for China by 5.6%, run from APAC and LATAM of 2.6%, gross margin a miss of 29 basis points, but that is down 326 basis points year over year. Revenue for the quarter is also down 9.3% year over year, and EPS down 44.9%. Now, as for Q4 guidance, so their Q4 guidance, which is the upcoming one, they said the following. Fourth quarter guidance, by the way, a miss, double miss. Fourth quarter guidance includes our best assessment of the factors based on the data that we have available to us today, which meaning, they're talking about the tariff impacts and all of that. We expect Q4 revenues to be down in the mid-teens range, albeit at the low end. This includes several points of unfavorable shipment timing in North America, as well as 2 points of negative impact from foreign exchange headwinds. We expect Q4 gross margins to be down approximately 400 to 500 basis points, including restructuring charges during the same period last year. We have included the estimated impact from newly implemented tariffs on imports from China and Mexico. We expect Q4 SG&A dollars to be up to low mid-single digits, including restructuring charges in the prior year. We will continue to tightly manage expenses while we increase investment to fuel our win now priorities, most notable demand creation. We expect other income and expense, including net interest income, to be $45 to $55 million for Q4, and we expect the tax rate for the full year to be in the mid-teens range. So, zooming out and looking at the big picture here, what we can see is one, footwear revenue is down 11.7% year over year. Apparel down 2.9%, equipment down 2.1%, global brand division that's up 33%, but really a tiny part of the overall business, and then Converse that's also down 18.2% year over year. So yeah, if you look at the footwear side of things, it's not new that it hasn't been doing quite well, right? It has been slowing down and it has been decreasing now for 4 quarters in a row. Not great. Not great at all. There's really no other way to put it here. Of course, how much lower can it go? That's basically the message right now that maybe the market is going to give us tomorrow. Because if tomorrow we see a small rebound, then maybe the market is signaling, okay, this might be the bottom. This might be the bottom, and we'll take it from here. We'll see what happens in the upcoming quarters. Could be. Then continuing here, Converse revenue, that's down 18.2% year over year. North America revenue down 4.1%, Europe, Middle East, and Africa down 10.4% year over year. Greater China down 16.8%. Some comments on that during the call as well. Lots of competition. They're still the number one brand there, but turnaround there is also going to take a while. Competition is much stronger today than it was a couple of years ago. And then Asia, Pacific, and Latin America, that's also down 10.7% year over year. And that was just revenue. If we look at EBIT, same story there. North America EBIT down 21.2%. Europe, Middle East, and Africa down 34.6%. Greater China down 41.7%. Asia Pacific and Latin America down 26.5%. Then Converse EBIT, that's the small part right here in the green, that's down 60.2% year over year. So yeah, if we look at EBIT, that has been declining quite quickly since the November quarter of 2023. And to be honest, since 2020, hasn't really grown much. Then touching on a couple of things that were mentioned during the call. So number one, product portfolio transition. They're focusing on sport performance products and innovation, increase the percentage of new products in seasonal assortments, reducing the contribution of classic footwear franchises, particularly the Dunk one, with double-digit unit reduction planned for fiscal year 2026. As for Nike digital repositioning, they will integrate digital within the broader marketplace. They will reduce promotional activities and markdown rates, which makes sense, right? If you have so many promotional events, you are devaluing the brand, right? Everybody's going to look at shoes and like, okay, this is on sale, this is on sale, this is not on sale yet, so we're going to wait until it's on sale, and then your brand is really not a premium brand anymore. It's garbage. Let's be honest. So good move here. Shift closeout liquidation to factory stores, and they expect digital traffic to decrease in fiscal 26 with a focus on building organic traffic over time. Speaking of inventory and marketplace cleanup, they expect to tighten product buys for Nike Digital to support full price sales. Makes sense. Increase markdowns in factory stores to clear closeout inventory. They're going to address aged inventory with wholesale partners through returns, supply reduction, and discounts. These actions will continue through the first half of fiscal 2026, so more pain ahead. As for wholesale growth, they expect wholesale to return to growth once new product flow, brand engagement, digital strategy, and marketplace health are restored. Again, going back to the comments that were made 3 months ago by the CEO, the turnaround story will take longer than expected. Last quarter, they said that the fourth quarter, which is the upcoming quarter, was going to have the largest and the greatest impact of the Win Now action that the new CEO Elliott outlined. And they continue to believe that this is true and it's their plan. But what we can also tell you is that we now expect Q4 to reflect the largest impact from these Win Now actions, and that the headwinds to revenue and margins, they expect to moderate from there. So again, going back to what I said before, this could be the worst of Nike at the moment. Could be. So yeah, maybe it's only up from here. I mean, the bar is pretty low. Let's be honest, the bar is pretty low. They continue by talking about the headwinds. They expect that these headwinds will continue in 2026. As Elliott referenced, while we're going to have positive things beginning vis-a-vis greater full price selling and digital, and we're going to have a clean and full price order book with our wholesale partners, we are going to continue to be liquidating inventory. And we expect that that's going to take us several quarters to work through. But the reason why we are confident is because we know we'll be liquidating it through the channels where we're used to liquidating that inventory. So we will continue to be transparent as we've got greater visibility as we get into fiscal 2026. So yeah, all in all, does it make sense for Nike to be trading at the same levels it's been, well, First up, the March pandemic crash of 2020, and then same levels it has been previously, so August of 2024, that Black Monday, August 5th, and same levels we've been actually a month or so ago. Does it make sense? Yes, I do think it makes sense. I do think it makes sense because there are more uncertainties today, more competitors today. Momentum is definitely not with Nike at the moment, although it still is an iconic brand, right? It still is Nike. It's known worldwide. No matter, I think, where you're going, someone will probably wear a real or a fake Nike outfit, shoes, you name it. Now, it's really up to them to prove to investors that they can turn things around, that they can reaccelerate growth, top and bottom lines. The question I have is why? Why choose Nike over, like I said at the start, one of their competitors, On Holdings? If you want to get exposure to shoes, athletes apparel, etc., why not go with a brand, with a company that is taking market share, that is cheaper, and that is growing faster than Nike? That's my question. Is it purely because it also pays a dividend? Does it make sense? Is it purely because of a turnaround story? Could it double from here in the next couple of years? Maybe. But what's to say the other company cannot do the same thing without the questions, right? The big questions of if and when and how they're going to do it. It's up to you. Tell me in the comment section below. I mean, I'm not hating on Nike, but I just don't see why you would buy Nike if it's not for maybe a dividend defensive play or something like that. So let me know. Let me know down in the comment section below. I would really love to hear someone's opinion on why or why you shouldn't buy Nike right now. Hit all the buttons as well, and I'll see you all in the next one. Bye bye.